Now, I'm frequently asked, how can you possibly predict your sales? And it is difficult with an early stage business without any past track record. But there are techniques. So what you can do is when you're looking at modeling and predicting your sales, you can break it down into units times price, the volume of sales times the price. You can break your sales forecast down by products, so you can get drilling down in it to get more confidence in your numbers. And importantly, use a technique called sensitivity. So you say, what if sales are up 15%? What if sales are down 15%? And through this way, you're going to get a feel for the future position of your business. And importantly, give yourself enough time to do something about it. With that forecast, you're in a much better position to deal with trouble coming up. Without that financial management, trouble has a way of sneaking up on you. So it's just essential that you've got those tools in place, knowing your working capital, getting your forecasts in place, and then you can do something about it. And a theme that I'm going to return to is that when you're thinking about what you've got to do, it's so important to act quickly. If you can see you're going to have trouble making a loan repayment, or you see you're going to have trouble repaying some of your suppliers, it's so much better to get on the phone quickly and earlier and start a conversation, whether it's your bank loan or whether it's a supplier, and start talking about what can happen. There's nothing worse for a supplier if they ring up for money and you don't return their phone calls, or you just go to ground, put your head in the sand. It's a disaster in terms of your financial management. So with those forecasts, you've got the time, get on with it, and start making some plans. So if your forecasts are showing that there is a problem coming up, and we all know that, well, we don't all know, but I found today that the Chinese symbol for crisis, or maybe HSBC will know this, the Chinese symbol for crisis is a symbol for danger and a symbol for opportunity. But anyhow, you can see there's a problem coming up. How can cost control help deal with that situation? First of all, you need to understand the difference between, or understand the fact that costs are not just costs. You've got fixed costs in a business and variable costs in a business. So let's use the sandwich shop analogy. Your variable costs, that's your mayonnaise, your bread, your boiled eggs, and your anchovies. You can tell what sandwich I'm partial to. The fixed costs, that's your accommodation, the premises, the administration, the marketing. Now, if you take your sales, and from your sales you take off those variable costs, what you've got left is the gross profit. Now, that is the value added. That's what you're in business to create. And if you express the value added, the gross profit as a percentage of your sales, that's your gross margin. And companies that are going to survive and indeed thrive in this difficult times are those that protect their gross margin. Okay? So, sandwich, £4, ingredients £1, the gross profit is £3. If you express 3 as a percentage of 4, that's 75%. That's your gross margin. Now, companies that will survive are monitoring that gross margin, and they are protecting it. They're protecting the value that they're adding. Very hard to do, especially in a creative business. I've done a lot with TV businesses. Creative entrepreneurs love their businesses so much, they just love polishing their product, and they end up giving the value to everybody else. It's essential that you protect that value. Now, how do we do this? Clearly, first thing, you're not going to put lobster in a £4 sandwich. So you have a clear idea of what it is your margin is, and you balance that with the price that you're charging. I would sort of respectfully disagree with Doug in terms of chasing sales. I think it can be a real mistake to chase sales at the expense of margin. I think a lot of companies get into trouble by being so sales focused. They're just looking at the top line. There's an expression, you know, turnover is vanity, okay? What's really important is the amount of gross profit that you're generating. You can start with the time that you've got available. Heather mentioned, if you've got more time, you can now start analysing your products. Analyse your products and your customers, and you'll see what the 80-20 rule applies to your customers and your products. 80% of your profit will be coming from 20% of your products and your customers. And in a difficult time like this, it's a question of actually possibly reducing your turnover, focusing on those products that are going to give you the most margin. There's also, you can look at revisiting your value proposition. Heather talked about practically from her business. I've done a lot in publishing. You can reduce the number of pages you're offering in a magazine. You can reduce the quality of the paper. You can move content offline. So it's a question about revisiting that value proposition. And the last point I would say is with your fixed costs. These are the ones that don't change a great deal. When you're starting up a business, wherever possible, try and keep those as low as possible. By which I mean, if you get the possibility of hiring rather than buying something, then hire that piece of equipment rather than buy it. It just gives you much more flexibility in a downturn. Great. Thank you very much.